Hello, this is Tom Siomades, Chief Market Economist here at AE Wealth Management. I can't believe we're 3 quarters through 2025 already. I hope everyone is well. Without further delay, let's discuss Q3 and what we saw. After an eventful first half of 2025, the third quarter of the year was less hectic, but there was still a lot going on. Let's cover some of the highlights because despite all the noise, markets did do well in the third quarter. I have said all along, with change, there's always some disruption. So far, 2025 has lived up to that. As with any new administration, some changes are to be expected. The first half had more than the usual amount of changes, and that brought a lot of turmoil and uncertainty. From a market's perspective, that turmoil has resulted in mostly a decent year so far, albeit a stressful one at times. As we moved into the third quarter, the market started the quarter at or close to record highs and ended it at or near record levels again. From that perspective, all went well. The one big beautiful bill was passed on the 4th of July, which took a huge unknown off the table. The 2017 Trump tax cuts have become permanent until the next tax bill is passed, whenever that might be. And we did not have to worry about tax rates reverting to higher pre-2017 levels. Markets welcomed the news, but a lot of that was expected and was already priced in. As we rebounded from the April lows after the initial tariff scare, there was progress and setbacks on the tariffs and trade front. Some deals were made while others are still being worked out. There have been challenges to the president's policies in the courts, but it does not appear that will discourage the administration from trying to reset global trade in our favor using tariffs and other innovative options. The quarter also featured renewed pressure on the Fed's Jerome Powell to lower rates in the face of a slowing job market. The economy, always important to both people and markets, took a bit of a backseat as the administration began to focus more on crime, immigration, and international relations, which dominated the news cycle as the quarter ended. From the National Guard deployment to fight crime in D.C. to promises to apply the same measures to other high-crime cities, to blowing up drug boats in international waters and bombing Iran's nuclear weapons building facilities. There was a lot competing for attention in the news cycle. The markets, though less volatile than the first half, were still pretty choppy and bounced around based on what was dominating the headlines. Lost were the decent earnings and other fundamentals that in quieter times the markets would focus on more intently. The further we moved away from the first half, the efforts of Elon Musk's Doge have mostly ceased to be reported on, and it appears the bureaucrats in Washington have weathered the storm, and it further appears that we have returned to business as usual, which probably means more spending and less accountability for government. That was a missed opportunity to lower government spending and reduce the size of government. We may live to regret that. Second quarter GDP rebounded to a 3.3 annual growth rate after a one-off minus 0.02% contraction in the first quarter, as a result of imports running much higher in Q1 in advance of the tariff announcements. I had said last time we were not on our way to a recession 3 months ago, and I was proven correct. We missed the dreaded 2 negative quarters in a row, which would have signaled a textbook definition of a recession. As of today, the Atlanta Fed is projecting GDP growth to come in at about 3%. The official announcement will not be until we're almost 1/3 into the final quarter of the year, on 30 October, but right now it looks like we're on the right path. Then there was the back and forth between Trump and the Fed's Jerome Powell, with Trump pressuring Powell to lower rates as Powell dug in trying to preserve the Fed's independence. Trump is also trying to fire Fed Governor Lisa Cook amid accusations of mortgage fraud. That might end up going to the Supreme Court. Trump also fired the head of the Bureau of Labor Statistics, claiming the jobs data was manipulated. Whether you agreed with Trump's assessment of the head of the Bureau of Labor Statistics or not, or of his pressure on the Fed, the revised jobs numbers showed that there were more than 900,000 less jobs created over the last year. Let me say that again. There were almost 1 million less jobs than was originally reported. Despite the rebound in GDP and with inflation remaining stuck at around 3%, job creation deterioration is a bigger concern. The signs are pointing to an economic slowdown. This is what finally got the Fed to lower rates by 25 basis points as we closed out the quarter. The question now is how much and how fast will the Fed move going forward? Will it be too little too late? All in all, the past quarter was very eventful, although not as topsy-turvy as the first half of the year. The market rewarded patience and discipline. As we close out the year, I'm sure we will have more surprises and new events challenge us. Remember, there's always something going on, and with the 24-hour news cycle, that something is usually a crisis, depending on who is reporting what. Because it seems everyone these days has a different definition of the word. Before you drop what you're doing and act, ask yourself if what you are hearing and seeing is something that would be considered a time when a difficult or important decision must be made. If it is, you have a crisis. If it's just noise and does not impact you, your family, or your community, go back to what you were doing and live your life. You have done the hard work, you've saved and you've planned. Now it's time for your money and your plan to work for you. So enjoy the fruits of your labor and skip the stress. Staying the course, being disciplined will be rewarded again in the fourth quarter. If your allocations have strayed from your targets, take advantage to rebalance now. Manage your gains and losses as we head into the year end. Do not get complacent or lazy. Stay diligent. Call your advisor and review your goals with them to make sure you're heading in the right direction and not exposed to unintended risks. Become a student of the markets and current events, and do not succumb to emotion or hype. I'll be back with you at the beginning of the year to recap 2025 and look ahead to 2026. Hopefully we'll stay on track and close this wild year out on a positive note. I know it's a little early, but since we will not be seeing each other until the new year, enjoy the holidays with your loved ones, and please reach out to your advisor if you have questions, and make sure your goals and objectives are aligned with your portfolio and strategy. Thank you and take care.